Okay, I think I'm alive. What I'm basically gonna be doing, guys, is I'm gonna be watching some content, and I'm also going to be trying to. Well, I'm not gonna trade anymore because I don't really want to trade, and the market's pretty much gonna be done in like an hour or 2 hours. So what I'm gonna be doing is trying to essentially refine my trading strategy by watching content, by Um, also looking at the charts as well, seeing what I could have done in certain situations. Um, I also wanted to study the charts a little bit more as well, so that could have been good. So I think I'm gonna pull up a couple of videos. They're gonna be off screen as well, so yeah, they're not gonna be here. So
Guatemala.
Guatemala, the fuck. Okay, what video was it? What video was it? Okay, got one right here.
Hello, everyone. It's been a minute since I've posted a YouTube video, and that's because I felt as though I'd covered a lot of ground in my previous videos here, and so I was trying to figure out the shortest and most concise way to explain the most important element of trading, which is game theory. And trading is a poker game, at least day trading is. All trading is to some degree, but day trading definitely is a poker game. A lot of the movement is dictated by market making activity, and so today I am going to quickly run you through the gist of it and tell you what, for some reason, very few educators ever explain. Before I do that, real quick, I am going to run another live webinar this fall. It's also been a minute since I've done that. If you go to my site here, you go to the live trading tab, you click on the CME CBOT futures markets, that will take you to the page that explains the structure of the webinar. In short, I'm going to start August 31st, and we're going to go through September 4th. I always like to include a non-farm payrolls day, so that's the employment number when I'm doing a webinar. So that's the first Friday of every month. So we'll run that week. It'll be a 3-day weekend for Labor Day. We'll come back the next week, do the 8th, 9th, 10th, 11th. Then everybody will have a weekend to digest it, and we'll come back on September 14th. I'll trade the morning, and then that entire day will be a Q&A session so that I can answer any questions people might have at the end of the webinar. All right, so if you have any interest in that, just go to my contact page, send me an email, and let me know. Before we get to the game theory element of it, let me just briefly touch on this again. The reason I watch the depth of market, and the reason pretty much every professional watches the depth of market first and foremost, is because this is the order book. This is showing exactly how many contracts are bid and how many are offer, and it's showing changes in those numbers, and it's showing the total amounts that are traded at each price, so you can see where there's been heavy trading and where there's been light trading. This information, when read within the context of also using game theory, can be very helpful. And you don't see a lot of this on the chart. People say, well, you see the chart go up and down. That's true, but you'll find if you'll spend time watching the depth of market that it becomes more natural, even though it doesn't seem that way to the eye, because it allows you to see the pace of the activity a lot better and allows you, of course, to see the liquidity, which makes a very big difference in how you have to approach the day. So when you're trading a market that is, say, the 10-year, which is 4,000 by 5,000 up, like most prices. That changes, obviously. Sometimes there's only 1,000 or 1,200 there or whatever. But the average lately has been around there, between 3,000 to 6,000, the bid ask. I know it seems like a lot, but you can see today, I mean, we had a pretty wide range even with that kind of volume, so there's plenty of opportunity there. Point being, the approach to treasuries would be very different than the approach to the ES or the NASDAQ. So the NASDAQ only obviously has 1 to 5 or maybe 10 on each side. The ES is currently averaging around 10 to 40 or 50. Yes, there will be trades or prices where maybe 70, 80 on a trade. But the average bid ask is running about 20 to 50. So obviously, the approach to trading the ES is the same in terms of understanding game theory, but in terms of picking your entries and your exits and stop losses is going to be different because this is thinner, there's less liquid. Less liquidity equals more volatility. The higher something gets in terms of price, the less liquid it becomes because it takes more money to trade it. And so these are things that have to be taken into consideration. If you're watching the depth of market, you are able to basically get a better feel of the ebb and flow and the pace of the action than you are if you're just looking at a chart. And you can also look at the volume profile, which a lot of people at charts don't ever look at, and this is a bit more useful in treasuries. So again, you can see maybe prices that held very, very well in heavy volume, at prices where it went through pretty easily, and there wasn't a lot there in terms of resistance as it was pushing higher. And then it hits resistance here, and no surprise, this ends up being the temporary high where there's more volume, right? So a lot of volume here, they push through, not a lot of resistance in terms of offers. More offers show up here, more volume trades, stops the move, at least temporarily. Idea being, if I'm long, I'm riding it through an area where there's not very much resistance and it's easily heading higher, and I'm exiting that trade, taking my money where I'm seeing it run into more resistance. It's a very simple premise. Possibly even reversing and taking a short trade and seeing if I can't catch a bounce, getting it back down. Okay, so this is the main reason professionals watch the depth market. It's very important. And now, just to show the comparison, liquidity does change over the months and the years. Again, it all depends on the market. So for those of you who are fairly new to trading, perhaps, I doubt you've seen this. If you go to my YouTube channel, I definitely recommend going to my playlist because I have everything I've done there in the playlist. It's my videos and some interviews that I did with other people. This is a video going back quite a few years. This is the ES. And you can see in the ES, there was 4,000 at the low in the bid. The average was running about 1,000 to 2,000 on the offers and the bids. So way more thick than you're seeing today. Which means less volatility, which means a different.
You always want to trade. I'm just like writing my notes, so I'm just treating this as like a note thing. Just because I've seen the other day like a YouTuber that was doing like a 1-to-1 risk reward ratio trade, and I just literally do not trade like that. Not because I'm just like stubborn. It's just like, to me, it's like you're wasting money, in my opinion. And I've seen his trades, but I would have put my stop loss extremely like tight, not because um not because like I don't know, I don't know. It's just I know that it's not, the stop loss is safe. You know what I mean? Just because the stop loss is just safe, guys. Let's say you take a trade. Let's say let's see, where is it? Stop losses are going to be safe. Okay. Oh, this is a perfect example right here. So stop losses are going to be saved. What I'm looking for is an absolute fatigue of the certain level. So, well, the trader might have put a, let's say right here, if it went wrong, you know what I mean? Like, he would have lost a lot more. And we're trying to gain a lot more and lose less, right? So, the whole thing right, this one is, I know that it's for sure 1000% protected just because I've seen this 1,000 times. And I'm going to reveal to you guys something else right now. You guys are going to have your minds blown, but this is protected. This stop loss is protected because it didn't even come and touch it. You know what I mean? It's just like, it's not even an uncertain thing. It's like, if you're trading with the trend, obviously it's going to want to not upset it, right? But if it pushed back down, if it broke that stop loss, that would have already made me think that, okay, well, it's going to, because this is pretty much like a stepping stone, right? It's creating a stepping stone. This is exactly how I think about the market, and it's worked out a lot with drawdown in my favor as well. So it's gonna make me think that it's respecting it. So that's exactly why I think this is gonna be protected as well. So not only is this area protected, but this wasn't even the first stepping stone. But when you do this, this is pretty much already respected. This is respected like this area right here, right? So it's never going to, you know what I mean? Well, at least this is my trading model. But like, it's never going to hit your stop loss. I don't know why we're not trading with the trend. Trading with the trend is law to me. It's like law. So I mean, it's always going to be protected, right? So let's say you took this trade, which would have been extremely good because it ended up taking off. It would have been extremely good. Like, you see a lot of fatiguing right there, a lot of volume right there that got rejected. This would have been protected. The drawdown wasn't even that bad, right? And then we ended up pushing up to new highs. You know what I mean? Same thing with this, you know what I mean? So, my trading model relies on something else. So, I don't know why you would trade this. This isn't even my trading model. But if it fatigues and starts doing it, well, this would have already showed me some effects that it wanted to push up, right? Because we closed above this. So, right here, should have shown right here. We closed, and then we would have been protected. We would have been protected right here, some drawdown right there, and then we pushed up. We're always protected, guys. We're always freaking protected. We just need to find the lowest pillar. If you find the lowest pillar, obviously you're more, I feel like if you find the lowest pillar, you're more likely to just figure out which one are, just be protected overall. For instance, like seeing this just made me think that, I mean, we were respecting this area right here. So I'm gonna just highlight. And yeah, I mean, that's true. We're literally seeing a point of control at the bottom of this shit, you know? We're seeing an extreme point of control right here. And this isn't my trading model just because I wouldn't recognize it. So I probably would have been stomped out here. But, I mean, we're rejecting areas. You know what I mean? We're rejecting the areas. Right here, would have been a good trade. Would have been a good trade. I'm not gonna lie to you guys, but we would have gone stomped out. Let's say you wanted to keep pushing forward, it would have been stomped out. I'm sure this was an area. Well, I guess not. But we ended up fatiguing right here. So right here, I want to see the point of control. Maybe the point of control is gonna be. I need to see the POC be more clear. Where is it? It's not changing. There you go. Actually, POC is gonna be yellow. Yeah, that way it highlights better. Yeah, so the point of control rejected this area. Same thing with this. It rejected this area as well. So let's see. This is a really big drawdown. So sometimes you could get caught in the middle of it. So I guess his model would probably work better here, right? 1-to-1. Because his model was like extremely large. Like it gave enough breathing room for this to work. So where was I gonna go? Oh, what was I gonna highlight right here? I wanted to see what. Yeah, I mean, do you guys see it? The correlation with the point of controls. It's like, well, shit. Well, we don't want to be here anymore. You know, there's too much. There's too much opposite sales coming down here. I think this is what they mean by supply and demand. As soon as you hit a certain level, there's orders waiting up here. Orders, a massive amount of orders that made this initial push. And we know that it started right here because we tried to push the market down and ultimately the sellers failed, and so the buyers won at this specific level. And it's just going to be natural that it's possibly going to happen once again. But up here, because this is such a strong push down, as soon as we closed above here, then it gives me some hope. Just because right here it's kind of uncertain, you know what I mean? We want to get rid of this strong buying. So maybe this candle I would have been looking for because it closed right above this candle. So that's what I would essentially be looking for, you know? I believe that candle bodies is really something that we should pay attention to. So that's what I would be looking for. It's just funny how this revealed itself perfectly. It's like, dude, we're seeing it live, you know? When I look at these two right here as well, when I'm looking at these two in specific, I see that and I see fatigue, right? I'm looking at that and I see fatigue of the market. It's no different than this. it's just at a different time. It's literally just at a different time, and the candle's printed in a different way. So to me, oh shit, I'm trying to show you guys some candles. Let's see if I could just draw it quicker. I'm gonna just do bootleg candles. What the hell is that? Oh my gosh. Okay, so my model would be something like this, right? We have the point of control, which would be yellow. The point of control, POC. Point of control with a bunch of orders getting rejected up here. And then the next candle, which would essentially be somewhere up here or up here, starting and completely surpassing this zone, which means it wants to completely start accepting higher orders. And the most important thing about this is not that it pushes up, but that it closes above, right? That it closes above that area right here, right? That it closes above this area right here, because that means there's a lot more interest and a lot more willingness and attitude for the market, that it was such a strong push and such a really good candle move that it wanted to continue, right? To me, that's a really good sign. So we could have like a little wick right there, a little wick, and then yeah, this would be honestly the perfect thing. We see it in, oh, I guess this was a really bad thing just because we're not trending with the market. We're not trending with the market, but the opposite would be this right here perfectly. So POC, honestly, if you have such a strong push like this, POC kind of matters to a certain extent. Point of control kind of matters, but I mean, you know what I mean? Because point of control could just mean, holy shit, we're really trying to sell right now. So right here, let me show this one. See, like we have a whole bunch of rejected orders. So that's why I get excited when I see more rejected orders above our longer wicks. So right here. And that's why the overall context of the market kind of matters in a way, because we want to trend or trade with the trend, because then your profits get higher. Let's see if I could erase it. Yeah, this might have been confusing, but let's see. Remove drawings. Let's remove some drawings. Yeah. Oh yeah, but that was one of the entry models, and I didn't really explain why. Same thing with this, right? This in a normal context would mean strong pricing. So I'm going to show you guys an example of this. Where is it? I guess a good example would be this one. This is exactly the same example that I showed you guys right here with the point of control. To me, this is the exact same. Because, where is it? To me, it shows right here, we have a really aggressive push down, right? Which is this black candle. And then it's like, oh shit, we stepped in a certain area where there was a lot of orders. Could it be right here? I don't know. I don't know what it could be. Maybe I should highlight it. Maybe I should highlight it just to reveal. There is a lot of orders here. Don't pay attention to the POC, but there is a lot of orders, right? Aggressive orders right there. So we have a strong push down, right? An aggressive push down of like probably one of the biggest out of like this candle. This negative candle is probably one of the biggest. And then we had a candle within the next one that essentially matched it. It's like, you know, you're not tough shit. You know what I mean? We're essentially matching your pricing. You know, we're essentially matching your pricing. And this is kind of like a zone where we get contested a lot, where it's like, what the hell is gonna happen now? You know, what is gonna happen now? Are we gonna match it, or are you guys gonna go broke? And essentially within the next candle, they kind of went broke. It's like, oh shit, you guys really don't have a lot of money to short the market, right? Nah, we're kind of short on change, right? We're kind of short. So what immediately happened with this next candle, and we actually ended up having a lot of buying power, that we closed completely engulfed this candle, and it said, yep, it's time. We're gonna essentially eat you guys alive and start accepting higher prices. We're gonna accept higher prices because your buying power showed. Your card at the dealership showed right here. The card at the dealership shows that you guys don't have as much buying pressure, buying power as you guys thought, right? And essentially what this does is a lot of different things within the market. First, you want to put pressure on them, and as soon as you put pressure on them, stop losses start getting tagged. And as soon as a stop loss gets tagged, that's like you're essentially buying, because that counts as a buy, right? You're essentially buying because a short is like you're in debt, so it says, oh shit, you could pretty much just, I don't know how to explain it. I really don't know how to explain it, but it just triggers a buy, so it essentially catapults the buying candles. It's pretty much the opposite happens as well, where selling at on a short or a buy kind of triggers each other's, right? So that's kind of what essentially what happens, right? So that's what ended up happening right here as well, right? It happens for both sides. So we closed above here, and then the next candle showed a shit ton of pressure to engulf this side. So that's essentially what I'm looking for. To me, this example is the same thing that I just showed you guys right now, right? Except it ended up looking a lot different, right? It ended up looking a lot different than this example, right? Because it's just a matter of, like, even if you were on a 30-second indicator, pricing just looks different because of the timing. It's all really about the timing, right? To me, these two, let's say these two, right? Let's say these two. Okay, I'll show you guys right here. This is essentially accepting higher prices, but this could be like a candle right here where we fatigued down here. Damn, I suck at explaining. I really do. Okay, fuck it. Let's do this. Boom, right here. This could be the candle, and then this could be this wick right here, right? Because we explored and we have a bunch of orders down here. Same thing that we, oh my gosh, why the hell is this doing this? Okay. Why the hell is it like so weird? Damn, now you guys are confused, or whoever's watching this. Yes. Okay. These two essentially merged into one, right? This wick counts as this wicks, right? Let's say, because it's a matter of timing. It's a matter of timing. And then we have a bunch of orders right here. And then this next candle is the same exact freaking setup that I just showed on the other one, where we're starting to accept higher prices just because of the body of that wick, right? Of the body of the wick. It's the same thing. It's like you could merge three, essentially. You essentially could merge three. The body of the wick. These are orders that got rejected. So we're pushing up, right? So that's exactly what's happening, and that's why I see this power, or this thing, a lot more different. So you could pretty much see the same thing right here, except we were in a downtrend, and then we pretty much crushed this next candle. It's like, ugh, I don't want to start accepting higher prices. That's how I see it. It's like, oh shit, I don't want to start accepting higher prices, so fuck it, I'm gonna just, you know what I mean? We squeezed the market essentially right here. We squeezed it just because it didn't really learn that it was a a freaking a downtrend. So that's why this didn't work. So okay, well, I would have sold right here. That's something that I'm starting to implement as well into my thing. It's like if this next candle isn't strong, um, then I'm not gonna fucking, you know what I mean? So that's something that I've been implementing as well. I need the next candle to be strong, to have strong projection, or else, you know what I mean? It's not gonna be in holding for much longer. So that's what I've been learning as well. So I think it's time for me to keep watching my video. I just wanted to do that. So
For an approach in terms of you have to actually trade more size and go for shorter moves, in terms of price. So you're basically scaling up to make money on more size. As price goes higher, liquidity becomes thinner, then you scale back on size, and because you're catching bigger moves in terms of price movement. And over here, you can see that the treasuries were actually thinner. They were averaging more about 2,000 per side, 2 to 3,000 per side, instead of 4 to 5,000 per side. So this does change. Jumping forward a little bit, you can see again here the ES isn't that as thick as it was in the previous one, but it was still somewhat thick, about 1,000 up or maybe 500 up at each bid ask. And then when you go forward here, to my last Order Flow Basics 2 video, you see again this 10 years about 2,000 on each side, and the ES had moved higher, so now it's averaging 50 to maybe 150 on each side in the bid ask. All right, so just adaptation is needed today. Okay, so here we go. Trading is poker. Game theory is the key. I'm going to use a simple Paint app here to draw charts for you. There's no need to go through actual charts. You all know what they are. You've seen them. You'll know exactly what I'm describing when I go through this with you. So it'll be very simple to understand, and hopefully it will help you in the coming months and years of your trading. So here we go. Anticipate the breakout before it happens. Don't chase too far after it happens. High of the day, low of the day. All right, market's trading in here. Now, this is the mistake a lot of traders make, particularly when they first get into it. They're looking at technicals and reading all the nonsense that's been out there for decades. The idea is high of the day, a breakout happens, the person waits for the breakout to happen, they buy up here somewhere, and they're buying because they believe the breakout will trigger off buy stops, more orders will buy, and then that's how you make money, right? Okay, that is true. That is the idea. From a game theory perspective, the market makers who have billions and billions of dollars to throw at these markets are constantly working orders all over the place. And there is manipulation every day. And I won't go into who does it, not going to name any names, but just know that I worked in the industry many, many years ago. I know what manipulation is. That's why I can make a lot of the reads that I make. They'll say it's not manipulation, that they simply have more money moving in one direction, but there's a lot of spoofing, there's a lot of games played, and it is game theory. So essentially what's happening is at some point, the market is trading like so, and then let's just say there is a market maker anticipating trying to spike a run through highs. So the market kind of hovers here, and all the retail traders are waiting for the break before they buy. The professional retail guy, or people working at, say, smaller prop firms, are reading this price action, and they're reading the game theory element, and they've seen it 1,000 times, and they're fairly certain that the market makers are going to make a run at highs. This is based on various information flow and obviously a lot of experience, but this is the idea. So buying before the breakout is the idea. So I'm looking to buy here whenever I think it's going to break, so that when it does break, if those buy stops get set off and the market rockets higher, I'm getting paid as that happens. And as soon as it shows signs of stopping, I exit and I take my money. Okay? The retail trade.
that's a good thing. I honestly do that. I think you guys could tell by my trades. I don't have a certain like RR win to risk to reward ratio. It's like as soon as I surpass a break of structure or I'm happy with because usually it's an average, right? If you make a certain average, I think you should be good. As long as you make like an average of like $100 per contract or $200 on a good day, you should be good. That's how you should treat the market as well. So I mean, I'm glad he's saying it, and supposedly this guy's good. So
Trader instead typically waits for the breakout, buys up here, watches the market reverse, and then pukes for a loss once it breaks back below the breakpoint, right? And wonders what happened. Well, what happened is there was a market maker that spent 30 minutes or 40 minutes or whatever building into long positions down in this area with the intention of running highs. Before the highs are even broken, the market maker is working sell orders above the high so that when the firm pushes and successfully creates a buy stop run, it already has offers working and is exiting the long position that it built here into the buy orders that are getting hit here. All right, it is essentially a pump and dump. That's what it is. They dump into it. They have all the money, so when they dump, there's no more heavy buying. People start exiting their trades because the market price stops. Very short-term programs begin shorting in anticipation of the market going back low. It does. The average retail guy gets caught. He takes a loss. All right, that's the game theory of breakouts. The next common trap retail traders face is not going for the reversal when it's happening and waiting too long, looking for a level to hold, and then getting caught because they acted too late. Very common. I'll show you. So here we go. Market is tanking, boom, 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 right? Falling like a rock. At some point,
He said go for a reversal, but that's the problem. That's the problem that I had in the first one. It's like, how do I make this loud? This is something that the reason why I'm doing this live stream is because I don't know, I want to educate myself or the people, my friends. That's pretty much it. What if because they happened, I was actually profitable like a while ago, and all of a sudden I just forgot everything. You know what I mean? It's like I didn't document anything, so it's like I never want to get to that place again. And then it took me like 6 months to start getting profitable again, to double my account, to get 100x return in like a month, or 100, not x, 100% returns, meaning I doubled my money. So it took me like a month and a half to actually do that. So I don't ever want to go through that again. So it's just really, really, really annoying. So that's why I'm documenting this, and I'm also refining my trading strategy. This shows signs. It's not giving me signs of it's gonna reverse off here. To be honest, it really isn't. Not now, at least. Not now. That's why we have to wait and be patient. It's not really giving me a sign that it's gonna push. Maybe if we close below this one, it's gonna give me a sign, but it depends on also what the fuck is happening.
except on those very rare days when it's just a complete one-way street. You have to anticipate that people on the short side here are going to start taking their money off the table in anticipation of it running out of steam. And this is what the market makers are doing. They're already short, probably way up here. They begin dumping off, let's say maybe early, send the market straight down like this. The average person will not look to catch the spike back up on that first bounce. And while it can be a bit tricky, again, I'm looking for those moments because that is what often becomes a straight up reversal, which is where you'll see it bounce, then it might pull in a little bit, but all that's happening here is the buyers are now amping up, catching these sell orders that are playing the pullback, right? And then spiking it again. And then they let it fall in, cover some, falls in. Somebody else is playing the 50% pullback. They buy those orders, poof, run it right back up again, and it recovers everything that it lost, maybe during the opening 30 minutes. So if I can catch it in here, I'm able to ride at least the first bounce, and if I'm reading it correctly, I catch the second, possibly even the third. If I end up waiting for a double
Right here, what it's making me think, this is weaker sell pressure. Like, this sell pressure is so damn weak, it's making me think it's gonna go up. At least as of right now. Okay, sell pressure coming in. Let's actually close on that. Okay, sell pressure coming in. If we close and it doesn't reverse like it did right there, if we actually close pretty strong, now it's gonna make me think I should actually fucking make a trade. Oh yeah, this is fucking Nvidia. What am I doing? It's not a future. But you can treat most of these stocks like futures, so I trade the stocks the same.
bottom, as they're called, or triple bottom, I missed the entire reversal. Okay.
Yep, it's starting a reversal. Yep, that right there. Not reversal, but like, I mean, it's gonna go down. It's gonna go down. Yeah, it's gonna go down.
The other route here, sometimes there's a double bottom. So it comes in, it bounces, comes back down, bounces again. Again, some retail might be anticipating this second double bottom here. Not uncommon. I would say, honestly, it probably doesn't happen any more than 50-50. So there's not really a reliable gauge in terms of statistically. But depending on the context of price action, if it makes sense that the selling steam has run out, what will often happen is buyers come in, it pops, the buyers pull their bids, they let it fall back in so that they can then buy again around the same prices. So a market maker ends up selling, covering the shorts. This causes a spike higher. The market maker doesn't buy up here. The market maker just continues working bids in this area. So when it falls, they buy again, then they push, and then often, you'll see it go like sideways like that afterwards. All right. So depending on the action, double bottom, possible buy. This is why the market maker or the large institutions are intentionally moving price in such a way. The next thing that happens would be this. So you don't catch the first bounce, you don't catch the second bounce, but now you have your confirmation, supposedly, that this is the level. The market starts to come back down here. You start working your bids. Doesn't spell very well. The market makers see the buy bids out there. They hit your bid and shove right through it on sell orders, knowing that they're about to trap all the people who are taking long trades at the bottom. They're going to flush those people out by continuing to push until everybody who bought here is now puking, selling here for a loss. The large firms that sold into these bids at the break point are now covering for a profit. You'll puke, the market will turn, come back up, and then do this for the rest of the day, and you're out of your money, and there's no chance to get it back. Everybody, I'm sure, has experienced that, right? So, try to anticipate the...
If it closes above this one, then I'm completely out. Yep, closed, I'm out. I would have been out of a loss right here. I would have taken a small little loss because it's about to go up. It's about to go up. It's going to reach new highs. Yeah, I would have taken that loss right there. Yeah, it just really depends what it does within my thing. But yeah, I would have taken that loss right there.
First, try to anticipate the second, probably avoid the third or fourth. It becomes less reliable the farther out it goes. The next common scenario that catches a lot of retail traders is what's called in the industry the shakeout. The way to handle this is either realize that a shakeout period is a real possibility and be committed to your read, or know that you don't feel like sitting in a trade possibly for 10 or 20 minutes and just don't take the trade and avoid the entire shakeout scenario if you don't have confidence in the read. What is the shakeout? The shakeout is quite simple. Maybe some large firms do have the intention of running highs. The market gets up to this area and you're anticipating a breakout and you actually do buy before the market hits the high today, and then suddenly the market just goes sideways and you sit for 2 minutes, 3 minutes, 5 minutes, 10 minutes, 12 minutes, and it just will not go. Eventually it dips like this. You decide to just take the trade off for maybe a small loss or a small profit or a break even, and within 30 seconds of you exiting the trade after holding it for 15 minutes, the market makes new highs and you miss the trade. This is by design. So these programs are amazingly efficient, particularly at reading all the orders that are hitting the market. And it's a well-known fact now that the majority of these day trades are very short-term. So the market makers know that the average person isn't really looking to sit in a trade for a long period of time. So as the price approaches the high, rather than run the high right away, what will often happen is the market makers will simply sit. And they're not dumping for a profit because they do want to push price higher, but they're not going to pay you while you're sitting in the trade. So they basically wait you out, which is called the shakeout. So they just continue working bids and maybe a few offers and some bids and some offers, and they're just kind of chopping back and forth, and they're monitoring all the trades that are taking place. And once...
This is good. This is good. This is good. Let's see. Yep, that shit happened. It's funny because my literal model got proven right here. It's just I got a read on the wrong side of the market. I thought we were going to fatigue. Okay. I thought it was a pretty good chance that we close. We didn't even close below this, so I made a presumptuous trade idea, I guess. But we closed right here. Earned, this probably was like 1 to 4, but this is pretty good. Now what would happen is I would just wait for a what's it called, a drawdown. Fuck, I forgot what it's the terminology I always called it. But let's keep watching this video.
That all the people who can be shaken out have been shaken out, and then ideally some of those people who were long have now reversed and gone short here. That's when the market maker will make the push and the market runs away.
I got a little impatient now that I'm thinking about it. I should have waited till it completely closed above, then it made a pull back just like it did right here, but I mean it didn't even close below, so
way they catch anybody who's short.
Should have waited till it closed below, made a pullback and then push down. Essentially did this, but on the opposite side.
The shorts took out for a loss above the highs, and then all the people that were sitting for this amount of time that exited missed the move. Okay, very common. It's possible to spot this again with some experience. I tend to avoid this situation. I just chalk it up as I don't know when they're going to.
Are we fatiguing? Let me see the 5-minute candle. How many orders do we have up here? It's alright. Not that much orders. And it still could pull up. Yep, still could pull up. These are just false flags.
Going to run the high, and if I sit in that trade for more than 5 or 6 minutes and it's still not going, typically I'll just chalk it up as a break even to get out of the trade, and if it runs away without me, it does. So either know that going into it and decide to avoid it, or do like I did, just take a break even or something. Or if you really have a strong opinion and you're pretty certain that you're reading it correctly, you have to be committed and then have a logical stop in place if it doesn't happen and starts to decline on you, or maybe have just a set length of time based on your product. So on your experience, perhaps you've noticed that a shakeout period on average it might last 6 minutes to 15 minutes. Fine.
And this proves again, right? People don't really know when reversals will happen. Same thing. I literally just got proven it. I thought, boom, we're gonna hit a reversal, and usually reversals are fucking rare. You know what I mean? It's just like my logic is mathematically you have much more of a chance. That's why I don't really go for reversals. So that's a trend, right? That's a typical trend. What you're trying to do is catch this move right here. What you're trying to do is catch this move when you literally had 1, 2, 3, 4, right? It's a 1 to 4 odds, right? That's what we're doing in trading. 1, let's say you enter right here, and then it goes down, and then but it doesn't stop your stop loss. It keeps pushing up to newer highs. Same thing happened right here. Same thing happened exactly right here. And what we're trying to do is capture this move that happens not that much. It's like, oh shit. It's like a 1 to 5. You have more options here to actually get it. You know what I mean? So you have more options to capture this move. You have like, it's like a 1 to 4, right? It's like, this is like 1 to 4 odds. Reversal. One of the good signs for a reversal is really strong like selling pressure, like this, but completely like double. This would have probably been a reversal if it like completely doubled, but knowing that this was such weak price, it's like it's only gonna do half pullback. That's what I see, at least. It's only gonna do a half pullback, so we just have to wait. And then we see here that it fatigued at a certain level. Let's see. Let's reveal it. Where really is the move? Right here. The move is right here. Right? So it makes sense. We ended up fatiguing at a fair value gap.
Hold up.
But there's a lot of fair value gaps. How do I know? I guess I know based upon the entry, which is my entry model just kind of saves me in that way, where it just, if it reveals that there's a lot more like enthusiasm with buyers, then obviously I'm gonna enter. So that's where my model comes in.
15 minutes, just get out. You'd have to design your own method for that, but very common situation. Okay, so quite frequently, what's happening in the market making world is that a designated market maker is simultaneously working bids and offers. This is something most retail traders don't understand. So a market maker might be trading multiple stocks, options, ETFs, and futures. And this is easier to see in lower priced stocks, but you can also see it in higher priced stocks. Sometimes in the future, sometimes the futures are moving too fast to really see it. But what you might see, let's say in a well-traded stock, has an average bid ask of around 40,000 shares. And you'll see that there's 40,000 shares in the bid, 40,000 shares in the offer. Here's your time and sales over here. And it sits around that time, sits around those amounts, and they change maybe a little bit, 35,000, 42,000, right on both sides. And not much is happening in the time and sales. And then if you watch pound sales, you'll see that 30,000 shares or maybe 40,000 shares trades into the bid. And the second that happens, the 40,000 shares on the offer disappears and price goes click, 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 click higher. So what happens in that situation is that the market maker was working shares on both sides, the majority of the shares on both sides. When he gets filled, or the firm gets filled, on the bid, it instantly cancels the ask, which now makes the ask seem weak, which now automatically attracts buy orders.
Right here, I'm looking at right here. If we close below this, this is going to be a really good short opportunity. Really good short opportunity. It's only if we close. Close. Only if we close below right here. Only if we close. Okay, well, we could still close within the next candle. Like I said, it's all about timing. And that opportunity's gone. I really do think now we're going to pull up. This isn't mine, by the way. This isn't mine. I fixed it just because of what could have been, but I wouldn't have taken it. Just because, no. It seems like it's more enthusiastic about accepting higher prices. So, and then this pussied out. So, I would take longs here. But this is from this trade. Right here. I'm gonna move it right here. It was more like right here.
Into that price.
Let's see. Let's reveal the fatigue. Yeah, it's pretty good.
And if they're working the next price, same thing. And it triggers some buying up a couple pennies or whatever, a couple ticks off of this price. And then once it clicks up, the market maker then dumps the 40,000 shares into the new bids. It is a classic technique that is used all the time. It is essentially spoofing, but if they're working these orders for a long enough time period, it's not. Consider spoofing. That's how they get away with it. So they get the fill, they cancel, they push, they cover. And they do that throughout the day. Obviously not all day, every day. You know, you can't manipulate it to that extent all day. Eventually, other market makers will catch you. But it's a very common tactic. So you're trying not to fall prey to that kind of a thing. And it's a good example of just the sheer manipulation that can happen and the game theory that is applied, which constantly traps people on the wrong side. Okay, so hopefully that's helpful.
Okay everyone, just wanted to make a video on just really the basics of auction market theory, which is what I trade. I do not trade market profile, it is not an indicator. Also enlarge the video because this will be in HD. So what do I have for you right here? I have for you a balance area. And this is what you see on a profile. You usually see these bulges each day, something like that. But on a bar chart, what does this look like? It looks something like this. You know, we have these market running higher and then it coming down, trading around here, 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 whatever, coming down here, 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 here. All this shows is that these are unfair lows, which is shown by low volume. And these are unfair highs shown by low volume. And then there's a point usually near the middle where there's a lot of volume. And the trick to this is picking the right trades at the right points, which are the high and low volume areas. So let's just go to present day market. You're looking at the Russell 2000. Now how is this shown on a bar chart? You can see it right here, a balance area. You can see we have unfair highs here and unfair lows here, and we have a lot of volume traded in the middle. And we will show that by putting on a little profile right here. You have unfair highs and unfair lows and a bulge of volume in the middle. Now the trick is trading at the extremes, which are the 95s in this case and the 93s in this case. And when you trade at these extremes, your risk to reward increases greatly. And you will also be able to find key areas on the profile, which are shown by single prints. I mean, selling tails, buying tails. Here's another selling tail, and then the high volume notes and the highs of days and stuff like that. So I'm just gonna go over an example trade I made in oil today. I entered it right over here. So let's just go through an overview of what was going through my mind in this trade. We knew we had balance here. We had an unfair high and an unfair low. So you want to be taking trades in and around these areas. Let's extend this a bit. It began to break out and we built value lower. That means that the market is officially in a downtrend. Once that was broken and we built value higher.
Whoa, 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 whoa. What ended up happening? We ended up fatiguing right here. Price got crunched. Dude, I'm like not even locked in. I look back and I'm like, shit, I just missed a trade. Shit. You would still be good depending on what this next candle does, but if you find an entry, I would still take it. You see how shorts just mogged this buying price? It mogged pretty much the whole fucking thing.
And we got accepted back into this value area, which means.
But then it depends on what this shit does. What I want to see, a really good trade. Yeah, if this completely just mogs this one as well, then that would be interesting. Then that would be worth taking. And then stop loss would be up here.
Means that there is a buyer stepping in as prices went lower. Usually when a market breaks out one way, fails, and gets accepted back into the volume, it's going to go to the other side. And that's just a known fact. And that's kind of what I was playing. So what I did was I used the big profile, which is this one right here. And what I did was I took a trade at the extreme of it, but also at the extreme of a smaller one. And what I'm going to do is I'm going to take the trade at the extreme of the small one and have the risk of that, but the reward of the big one, which is right here. So going into the types of trades, there are two types of trades you can make. Responsive, which is buying this end of the profile.
This would be a trade I would take. I would have taken it as soon as I seen that it was right here. Stop loss would be right here.
Or selling this high, so you're going against the trend.
And then I would target somewhere within this area. Somewhere here, because timing is not going to be perfect. Right there. Somewhere within this area would be nice. Somewhere within this area would be good.
Or being initiative, which is selling the break and buying the break of the other side. What I was doing was I was buying the responsive trade in this profile with the risk of it, and I was also buying kind of an initiative / responsive trade because I was looking for it to go initiative here, but I was buying against the overall downtrend. So remember this, I had the risk of about 15 cents or $150, but I had the reward of potentially 500, 1,000, and it goes on. Really, your minimum target is the high volume node of the profile, so your minimum target was 800. That's about 5 to 1. So that means you could have four losing trades in a row and have one winning trade, which will put you on the winning scale. That takes a lot of emotion out of trading. Oh, your minimum target was 800. That's about 5 to 1. So that means you could have four losing trades in a row and have one winning trade, which will put you on the winning scale. That takes a lot of emotion out of trading. I'll give another example. In gold here, I bought, and really this is a real trade, and I still have it marked actually. You can see this red line I drew right there. I bought this right here, and I didn't have to be a magician to do that. All I knew was that we had an unfair high here and an unfair low here. Gold was overall in an uptrend, which you can see by value building higher. So you want to be a buyer either way, either the break of this or a buyer down here. All I had was a stop down here of about $100, 1 point, but my potential reward was 69, which is about 500 and higher. A lot of traders, they trade in these random areas, and that's what gets them killed. The risk to reward in these random areas are terrible. They're usually 1 to 1 or even worse. But when you're trading at extremes, here and here, the risk to reward increases, and that's what really auction market theory is about. So let's go back to this again and go over the trades you can make. You can either take the responsive trade. Oh shoot, let's use this. The responsive trade, which is the sell here or the buy here, or you could take the initiative trade, which is the buy up here and the sell down here, or breakout trades. Your stops for breakout trades are usually just above the low volume, or here, and for responsive trades, just above the high, here or there. But your potentials is for the initiative trade is the length of this profile in that direction, or responsive, the length of the profile in that direction, when taking it at the lower extreme and vice versa for the top extreme. The ideal trade in auction market theory are the ones where, let's say you buy it at this X that I'm drawing right here, where you first have it as responsive, the market continues to go higher, and where it breaks out and turns initiative. Those are the trades that are going to make your account explode literally by 20%. And same on the other side where you short it near the high and you have it break low. Like, think about it. Let's say your goal is to catch the high of the day. You could try 4 times at, let's say in gold at this extreme. Let's say this was the extreme, stops you out. Try it again here, it stops you out. Try it again here, it stops you out. Try it again here. You've probably accumulated, 3 losses of maybe $120. So that's a good, 360 to 400. But one trade is going to make that all back. And think about it. When you're entering short here, you're going to hold in until something says get out. And that is indicated by a bounce area forming higher. So you can see, balance kept forming lower. Nothing was saying sell until this thing broke right here. So you want to be taking it off in around this area. So that's how much? 1,200 when you lost 400. So you're up 800. And that's how you make your money. You're going to have more losing trades in the beginning. And then big winners that wipe it all out and give you a lot more money in return. And once you increase your knowledge about the market and your feel, you'll be getting more winners, and that's going to increase your profits even more. So that's the key, really the key to trading properly. Like, in the long run, you're not going to make money risking 50 to make 50. You have to be risking less than you make. A regular trade you're going to get is ones where you risk 50 to make 250, and then you will find some where you risk 50 to make 1,000. And those are the trades that are going to make your day. So thanks for watching this video. All my videos will now be in HD. Thank you.
Good video. Oh, this makes me want to leave. This makes me want to leave. Okay, you know what? I'm gonna risk it just because. I'm gonna risk it. Because we're not fully right there. So that's what gives me hope. It's the only thing that gives me hope. If it was completely above here or slightly above here, I would have fucking closed. But right now we're in test mode, right? We're in test mode, refining our skills.
Alright, hello and welcome to this video on tape reading for, well actually it's a tape reading tutorial for futures, but it applies for stocks too. So we've got a little higher high here. This is the point. You can see the blue line. Question is, will it continue to follow through to the upside or to the downside? And the market's moving faster than I can talk, so can't really kind of see what's happening. But in real life, I got started talking here a little bit late, how would you determine that? That's one of the big questions. Whenever you talk to a trading teacher, you should always ask them the question, well, how do I determine whether, this is going to happen or that's going to happen? Tell me specifically, tactically, exactly, specifically give me the rules. So here's one of the rules that I use. I bring up a time and sales window, which you see on the right side of the chart there. And with that, you can actually see each order that comes through the market. So now we are seeing not just the volume histogram at the bottom, which is limited. That shows you the total number of, in this case, contracts, because we're looking at the NQ, the NASDAQ 100 futures. But we're actually seeing each order and the volume of each order. Now I've got that customized so that I don't see any orders less than 5 contracts. I am not interested in anybody trading 1, 2, 3, or 4 contracts. So I've gone in.
Dude, I swear to gosh, this video is literally just, this live stream is just literally going to be this. Like, literally myself live proving this shit, bro. It's like I'm not even trading with the fucking trend, bro. The trend is that way. And yet I'm trying to take reversals! Oh my gosh. Good thing I'm doing this like fake, bro. Honestly, don't even take these trades. Like, this is me. This is my shit. I'm fucking learning. You know what I mean? So, yeah. I don't know. Sometimes the market just tricks you, bro. These things work. Right? Like, literally this shit has worked. And I'm literally proving that I don't know when reversals are gonna fucking happen, bro. Live. So, this is a reverse. It's like, you guys see this big trail and it's like, oof, that looks juicy. What if we reach the bottom? You know what I mean? At the top. And we sold up here. It's like, bro, come on. Like, we're dumb.
Filter those out, and you can talk to your software broker or your software providing company about how to do that, if they allow that, so forth. This is NinjaTrader 7. And they do allow you to do that. So I'm only interested in a little bigger orders. I'm not interested in the amateurs here. That really means nothing to me whatsoever, so I want to filter them out, and I do. So I'm only looking at trades for 5 contracts or more. Even there, obviously, you're going to get some amateurs. But as you can see, when we had the little breakout there, and this is a big problem, right? False breakouts. How do we determine whether it's going to be a false breakout or if that breakout is going to follow through to the upside? So this is one of the solutions. This is one of the how-tos, is by bringing a time and sales window and looking at, all right, what is the dominant direction, or I should say the direction of the dominant energy of the market? And this is not bids or asks, by the way. You can also put bids and asks in there. You see the bids and asks at the top. I really couldn't care less about the bids and asks. It means nothing to me. So I filter those out as well. And I only look for the actual orders, the commitment of the money that the market participants are putting in, because that I know they're serious about. Bids and asks can be pulled, and they can game the market that way. So therefore, that's meaningless to me. Now I want to know, talk is cheap. Actions speak louder than words. Bids and asks are talk, and actual orders being filled, that's actions. So that's what I want to see. And as you can see, it dominates the red here, and it has ever since the breakout. And we got some decent sized orders, nothing real big right here now. But at least these are not people who are just trading with the very minimum accounts available. That's not going to be your smart money people. We want people with decent sized trading accounts, and therefore can afford to trade 5 contracts. And remember, when they're trading 5 contracts, that might not just mean that they're trading 5 contracts on that trade. They might be sizing in, so they're trading.
Yeah, good thing, dude. It's like I never learned this I never learned this lesson of like I think I'm gonna time reversals, and maybe it gets past here, right? Maybe it gets past here, but it's gonna push up. You know what I mean? It's like reversals, you really never know when it happens, you know? It's like you get 1, 2, 3, 4, 5. Literally the same exact. This is what I think is gonna happen. No, bro. It needs a shit ton of volume and commitment for that to happen. More than likely it's gonna keep pushing up, or if you're in a downtrend, it's more than likely gonna keep pushing down.
Trading 5 contracts, and then they get in with another 7, and then another 8, etc. So keep that in mind as well. Doesn't mean that their whole position is 5 contracts. So that's part of the reason that I do that. And anyway, the market's still going down here, so let's take let's just stop here. We've already seen this false breakout, and let's stop here and look at another example. Okay, so now we are coming down. You see the blue line below us, and so that's support. And so now the next question is, well, is the market going to hold that support and bounce off, or is it going to break through? Well, again, market moving pretty fast. Look at the time sales window and all the red orders there. In fact, we have block orders. If you notice, that says block. Okay, so anything that's over 20 contracts, I designate as a block order, and that just means, okay, those are really big orders. And in the S&P, I'll usually use 100 contracts, or sometimes 50. Anyway, we broke through that support. That's why that blue line went away, because my support resistance levels like that are automated, and so therefore that support level no longer exists. And you can see that, yeah, sure enough, we broke down below that, and you can tell that because with price bars alone, you may not be able to see that. It might be unclear. But when you look at the time and sales window, you can say, oh, okay. So not only do we have a lot of sell orders, but there's big volume in each one of those orders, and we have those what I call block orders. And look again, still red, red, red. There's another block order that's coming through at 25. We're in another support level, and let's see what happens here. Now we got some green block orders, 37, 20, 10, 38, and so we got some big orders, some more green orders coming through. And so see, now the market goes back up. And technically, basically, now we're block orders on the green side, the buy side, and so the market's not really breaking through that support level. Got a little below it if you ticks or whatever, but yeah, we're holding that level. We got some buying coming in here, some accumulation coming in. Hasn't really pushed the market back up yet, but we are indeed seeing lots of buying, large orders coming in. You're always going to get buying and selling because it takes takes both to make.
Okay, I was gonna hold it, but it depends on what this specific one does. I was gonna hold it, but it just depends on what this specific one does. So for instance, we were in a fair value gap. So right here, I would close my position. So that was wrong. Because it wants to use that fair value gap as a bounce.
Make a market. Obviously, every time somebody buys, someone else has to be selling, and someone selling, they've got to buy. And so there we go. Okay.
But then again, I am fake trading. This is not. I don't recommend you guys trade because I'm literally trying to practice, develop. Because I haven't done this or dedicated enough time.
Now, by the way, when it's light green like that in the time and sales, that means people are actually overpaying a little bit, and that's a sign that either they're getting a little slippage or they're just being really aggressive on the buy side. And when it's magenta, then it's they're being a little aggressive on the short side or getting some slippage there. So and there we go. So you'll notice it doesn't happen necessarily right away on the spot at the moment, but that's what's called accumulation. That's what's called accumulation. People are taking positions, they're building long positions. And we got another block order at 27. And so, that's the smarter money, so to say. And we're back above that, what was a support level now, and we are coming back up. And that accumulation now has turned into an actual reversal of the market direction. So that's how you do tape reading. That's your tape reading tutorial for futures. And that's basically what I do and watch for.
Holy shit, I should have sold. If it reaches down here, I'm gonna rethink my whole strategy behind certain things.
And especially at support resistance levels, this is how I primarily use it, at support resistance levels and at swing highs and swing lows to determine whether the market will follow through, whether breakouts will follow through, or whether they would fail, and if support resistance levels are going to hold, or if the market's going to fly right through them. So if you like this video, please understand that, sure, it's free, but if you got value from it, you actually have a moral obligation to pay it forward by clicking on that beautiful little share button below. And if you do that, it's a spiritual thing, because you know what? We assume everything's so free on the internet, but really, if you found something good, really should pay it forward.
Oh my gosh. I guess just literally don't follow me for trading. Literally just do not follow me for trading. Good thing I'm not trading. But this live stream will serve as a good and I guess it did respect. Dude, I swear to gosh, trading is so freaking weird. It might have just respected this area, bro. It was literally using this as a protected zone, bro. I just wanted to see where it had it,
Or just as it's good karma. And if you're watching this on YouTube, please click the thumbs up icon and leave a comment because I love your comments. They actually encourage me to create more free tutorials for you. I do them every week, and I'm motivated. I don't make money off of doing these, but when I get good comments back, then it encourages me to continue on. Also, I'm giving away my rubber band trade strategy. Now, this is a complete trading strategy that has a very high win-loss ratio, and it's a simple trade. I'm going to teach you the whole thing with all the rules, all the filters, everything, so you can start trading it yourself. And it comes in a video that's about 26 short minutes. So get my rubber band trade strategy absolutely free by clicking on the image in the top right-hand corner or the description below the video. And if you're not watching on YouTube, there's probably a link below or an opt-in form on the side. Once you do that, I will personally email the video to you with the rubber band trade strategy.
These high time frame levels are pretty specific here that I want to go over. Things like chasing win rate, even having a daily bias, being hyper observant of every candle in the 1 minute or a super low time frame chart, kind of hyper analyzing everything. And some people even go into a state where they're like borderline panicking over the market. These things are typically not just unlucky habits, but they're the default way that most retail traders are taught to think. Win rate matters, which I know is probably a controversial claim that it doesn't, but we'll get into that later in the video. I believe that having a daily bias is a bad idea. Okay, this is what most people have, and I think it's a bad idea. And most people are trying to sit here and predict the market, which I think is ultimately the biggest problem that most traders have. But again, like I said before, these aren't really just unlucky things that you're built with. They're just the default way you're taught to think. Now, the promise that I have for you by the end of this video is that everything after this section of the video and forward is going to be aimed towards replacing those bad habits with a process that's going to put you in the best position to be profitable. All right, let's talk about how to think about a chart. The first point that I want to make here is that you should never believe that you know what the market is going to do. Okay, if you have a level on the charts, if you have a thing that you think that the market's going to react to, you should never actually believe that that is going to hold or that's going to influence price action. The first fundamental belief that you need to have is that no matter what the fuck that you put on the chart, the market is going to do whatever the market is going to do. You have to come at this through the lens of having an edge. Okay, think about the market like you are the owner and the CEO of a casino, where in a casino a player can come in, they can play a hand of blackjack and they can win. In that casino, they're going to want that player to continue playing for a long time, and it's because the casino doesn't know if the trade's going to win or lose, or in this case, they don't know if the gambler is going to win or lose. They have no idea on the individual hand, but over a very long period of time, they know that they're going to win, and the math is going to work out for them. And trading is the same way. You have no influence or no control or no understanding of what's going to happen in a moment, but over a very long period of time, the very small edge that you could get can turn into a very large profit. And you could get certainty in a huge amount of time, but you can have no certainty on a day-to-day or especially a trade-to-trade basis. Next up, I believe that most traders are thinking kind of inside out. They go onto the chart and they look directly at a very low time frame, maybe a 1 minute or a 5 minute chart. They try to guess the direction from there, and maybe they even use levels on such a low time frame. In my opinion, you're doing that backwards. The majority of your levels, in fact, all of your levels, and all of your bias and anything else that you have should come from a very high time frame. And then you should utilize the low time frame to trade in the realm of those high time frame levels. And this is a very simple idea. It's because high time frame levels and high time frame events are probably more meaningful, more impactful to the market than whatever the fuck your 1 minute candle is doing. Now, when you start to think about the market like this, it leads to the natural question of how do you actually trade? And the rest of this video, I'm going to be showing you the setup that's generating me tens of millions of dollars in the market at 22 years old, and exactly how I personally think about the market with these underlying beliefs. Now, my setup is called the 4 pillars setup. It's called that because there's 4 distinct steps that need to happen in order for the setup to show up, and that's what I'm going to be showing you right now. So pillar 1 is really easy. I'm going to be looking for the easiest equal lows and the easiest equal highs before the US market opens. And for me, I'm in Denver, Colorado, and the US market opens at 7:30 a.m. So if you look here on the screen, if you look down below my cursor, this is 7:15 a.m. So I go to the 15-minute chart and I'm looking for the easiest equal highs and the easiest equal lows. So before the market opens here, if you go left in the market, this high rejected off of this high. This is the easiest equal highs on the top. If you look prior on the bottom, this low, rejected, this low. This is the easiest equal lows on the bottom. And this is where we define our liquidity. And in pillar 1, all we're doing is we're waiting for the market to sweep one side of this range. So what that means is to trade up into one side of this range. Now we have the market trading above the highs. Now we have pillar 2. So the chart's changed a little bit, and there's a couple levels on the screen. These are my high time frame levels, and how I mark these high time frame levels are pretty specific to me. Now you 2. So what that means is to trade up into one side. Pillar 1, all we're doing is we're waiting for the market to sweep one side of this range. So what that means is to trade up into one side of this range. Now we have the market trading above the highs. Now we have pillar 2. So the chart's changed a little bit, and there's a couple levels on the screen. These are my high time frame levels, and how I mark these high time frame levels are pretty specific to me. Now you could learn how to mark these high time frame levels on my YouTube channel, but to be honest, there's a lot more that goes into it. And what I mean by that is there's ways that you think about these things. Pattern and showing exactly how to mark all the levels, but really I want to understand the system and the process. We had pillar 1, which is a sweep above this high. Now we have pillar 2, which is a high time frame level, and that happens right here. Okay. This is important. We need to have a clean rejection off of a high time frame level after the liquidity sweep. And it could happen something like this, where let's say that this black line was a high time frame level, you get a sweep, you don't trade to a level above it, but then you regain a level below the liquidity and you reject off of it. This highlights an important part about this setup, where it's less about the location of where these events occur, it's more about the order of which these events occur in. You need the liquidity sweep, and then you need the high time frame level test. Now we have pillar 3, which is a projected defined range bias. Now a PDR is something that I created, but it's basically saying you go level to level. So you need a range where after you trade into your high time frame level, the next high time frame level is pretty far away. You have a big gap in price action. This is the highly likelihood range that price is going to expand from.
Okay, so I'm currently learning other stuff. I'm checking out other people, how other people trade, trying to see how I could refine it, perfect it, better my trading understanding. Right here. Seems like the original trade was actually going to work out. Just because we actually responded to this level. We rejected it.
And if price does expand through here, this is where we get our opportunity from. And pillar 3 is all about building targets. Your first target is the completion of the PDR, which if you've watched some of my videos and you know what projected defined ranges are, you know that the PDR starts here and the PDR ends here. If you haven't watched some of my videos, and maybe this is the first video that you've seen of me, just understand that you go level all the way to the next level, okay? And that's the completion of the PDR. These levels in between are what may or may not stop it and how price typically stair steps down. The second target is the other side of liquidity. If either one of these get hit after liquidity sweep happens, so after pillar 1 happens, that means your 4-pillar setup is done for the day. But this sets into motion your bias, and now all you need is some form of internal confirmation. And this is where we have to start to talk about the concept of a stage. So when I say stage, the 4-pillar setup is a stage setting. It's a stage setup. And what that means is that once you have all 3 pillars, this is showing you that the 4 pillars exists. It's showing you that it's there. It's showing you that it's
What
able to be
the
used.
hell
Pillar 3 is completed.
just happened? Is it frozen?
Or the bias is completed. So until you trade to point B or you trade to the other side of liquidity, you can take any entry at all down into that level because you're playing this stage that the 3-pillar set, but you're executing with the 4th one. And the 4th one is called internal confirmation. Internal confirmation could be just about anything. Now, the great thing about internal confirmation is that it happens until the PDR bias is completed. So it could be something as simple as gaining a order block up here. Oh, should place that. It could be something as simple as gaining this order block up here and trading up into it inside of this candle. You go short on that order block with a stop loss above it. It could be something as simple as turning this fair value gap inversion. You go short on the retest of that inversion fair value gap, putting a stop loss above the inversion fair value gap. It could be something like a retest of a PDR level, right here. You go short there. I don't know exactly where you put your stop loss, but you could go short there. 609, retest of the PDR level. You could go short on the fair value gap that gets created, putting your stop loss above the fair value gap. You could go short on the wick that held price up, got closed underneath, and then got retested right there. You put your stop loss right above the wick. You could go short on the next high time frame level tested. What I'm trying to tell you is that the 3-pillar set the stage, and internal confirmation is any entry that you could get in the direction of that bias. Now, the whole framework around these entries is that we're not necessarily optimizing for win rate on these entries. We're optimizing for how often can we get break even. And the reason is because most of these entries have very small stop losses, which means the risk reward is very big, which means that the win rate of these entries is probably a little bit lower. But if we could optimize for at least hitting bounce and going to break even as quickly as possible with their stop loss, then we could play a lot of these entries and
Let me see if there's a big rejection at these levels. There is. That's worrying. It might just bounce off this. So this would be worth closing again. But yeah, I mean, we rejected this area. More than likely we rejected these areas. We rejected it twice and 3 times. So more than likely, what I'm trying to do is push up, and that's probably what I would do, honestly. So I would essentially close my trade right here. We've gotten some profit, but it seems like we want to bounce off of this level because we reached it. We got an area of liquidity right here.
even
And it seems like there's a lot of orders that want to keep pushing up.
the low win rate after adjusted break-evens. So if you don't count break-evens in your win rate statistics, I have about a 55 to 60% win rate with this setup, and my average R is over 10 R, which is ridiculous. That's better statistics than you'll find anybody on the entire internet having. And this isn't just a random claim. This is backed up by 4 years of live trading to call every single day, every position, every execution, every loss, every win, every break-even, in front of hundreds of people every single day. Now, that's the framework. Pillar 1, the liquidity sweep. Pillar 2, the high time frame level test. Pillar 3, setting into motion a projected defined range bias. And Pillar 4, having your entry or internal confirmation. The way that you manage these trades, you'll never use a take profit. You use a trailing stop loss. That way, if the market keeps running, it keeps going, you're going to stay in that position until it takes you out. The reason that we do this is because a take profit is telling the market what it needs to do, and a trailing stop loss is reacting to what it's actually doing.
Low-key didn't get that, but let's keep going.
Alrighty, so the name of the setup is a 4-pillar setup. And on the surface, it's actually very, very simple. That doesn't mean it doesn't get more complex. It does, but it's very easy to use and it's very easy to see once it's something that you know how to do. So it's called the 4-pillar setup because there's 4 distinct steps about the setup. The very first thing is that you want a liquidity sweep. Now, later in this video, we're going to go over exactly where to find that liquidity sweep. But right now, I'm just showing you the hypothetical, kind of theoretical part of the system that you need to know. Once that happens, you need a high time frame level to hold. Again, how we mark these high time frame levels, that's something that I teach and that's something that I talk about in other videos on this channel and also in the private community. But marking the right high time frame level is important, and you need the high time frame level to come after the liquidity sweep. After that happens, you need a bias.
Dude, literally everything, like nothing, none of my calls have worked, by the way. I literally try to call something, but it seems like we're going to close below here, and it seems like we completely just recuperated all the work that we've put down here.
So
I wonder why. Why, though? But it makes sense, bro. It's like literally what I was doing was correct. It's like, I'm so retarded. Literally.
Something that I call PDRs, or projected defined ranges for this. When I have a high time frame level hit, the PDR is set in motion to the next high time frame level. I'm playing level to level. That's basically what I'm saying. So once that happens, I have the PDR defined bias, projected defined range to the next level. That's pillar 3. Then you need some form of internal confirmation to tell you that everything's actually working how it should be. Typically, this is found in the leg that is right prior to the liquidity sweep, and that is usually going to be whatever held down price action breaking out and getting a retest of that. This provides entries with very tight stop losses with very large risk reward potential. The philosophy of the setup is that once you have the 4 pillars in motion, you have a stage. And until pillar 3 or the bias is completed, you are going to continue to have that setup. So you can take many entries on the same setup, and the idea is that the entries that you're taking, ultimately you're going to get lucky with, and because they have tight stop losses, you're going to be able to have a very high risk reward with a relatively high win. So that's pretty much the theoretical part of the system, just talking about in a really basic drawing to get your brain kind of starting to understand it. Now we're going to go over a couple of different examples, real trades that I took in real time in the Discord in front of a lot of people to go over and kind of solidify this in your brain of what exactly you're going to be looking for. So the first example that we're going to look at here is Friday, July 17th. So the very first thing that I do before the market opens is I'm looking on a 15-minute chart for the easiest equal lows and the easiest equal highs for my liquidity sweeps. The easiest equal highs on top, in my opinion, is this collection of highs up here, sitting at the price level 841.25. So go ahead and mark that. And then prior to price action, the current price action doesn't have a low against this low. So I'm going to consider these the easiest equal lows. I have to look back in time, and these right here are the closest, easiest equal lows in price action. So now we can drop down to the 1-minute chart, and the great thing about this setup is nothing actually happens until we have a sweep of one side of these lows. So we sit on our hands and do nothing until one side is swept. That happens right here. This sets into motion our phase 1 of our 4-pillar setup. This is pillar 1. Now what do we need? We need a clean high time frame level. So price action falls down beneath this big level quite a ways. And to be honest, this is where most people are going to get shaken up. They're going to see the market is trending lower. It didn't hold the level perfectly, and instead of sitting here waiting for the setup, they're actually going to get shaken up and probably try to go short off of a retest underneath this level. But we know trading this setup, and in the mentorship when I was trading this live on the day, all that I said is that, hey, we could go underneath this level, but since we ran the lows first, I know that we're looking for long. I have a bias that I'm going to stick to. The next thing that we need is a high time frame level test, a clean one. When does that happen? That happens after price closes back above the level, and we get a clean test right here. So yeah, we were underneath the level, but we know that we're going long. So we need to test the high time frame level, and that's where we get the test right there. Does that test set in motion a PDR? It does, because holding this level sets in motion a PDR up into here. Because again, we play level to level, so we think that we're going to go all the way up to 29,013.5. So we have all 3 pillars.
I might just do this model tomorrow. I might just test this model out tomorrow. Oh shit. Oh fuck, I was literally looking at this. I'm like, dude, if we close above here. I know it sounds fake, but literally, I mean, we were approaching it. So, dude, it's like, dude, I'm flip-flopping. It's like shit. And then as soon as I seen this, it's like, dude, I'm really a mess. But I mean, that's just how the market is, right? We're confused and stuff like that, so makes sense. This was really my perfect setup, perfectly calculated, but happy flip-flopping, so who cares? This makes me think we're gonna completely crush this.
Basically, anything at all is something that we're going to be entering on at this moment in time. Now, in terms of internal confirmation at this point, we already have 3 pillars that are set up. There's a couple ways that you could play this. And again, the 4-pillar setup is nice because there's always going to be more ways to play as long as the PDR bias has not been completed and as long as both sides of liquidity have not been ran. So the way that I end up playing it is once that level got tested, I took a retest of that level right here with a stop loss underneath this low. The reason this is internal confirmation for me is because sometimes the high time frame level test can be internal confirmation. And understand, even if you trail out underneath this, you're making 13R on this trade. If you trail out all the way at the highs, and this is kind of unrealistic, most of the time you're not going to get this big of a trail out, you can make a potential 64R on this trade, which is fucking ridiculous. And you know, pardon me talking like that, but it is really ridiculous. Most of my winners are going to be in the realm of more than 10R. Okay. The next thing that you could have done for internal confirmation is you could have looked at this tiny little wick inside of here. The reason why you could look at this little wick is because this is the wick on the leg down that held price action, and that retest of that wick right there at 578.75 could be something that you could take. This is also the reason why you could use this wick is because there's a volume imbalance right here, which overlaps the range of that wick, making this wick a more higher probability spot for price to long off of. And if you took this trade, your stop loss would be right underneath the wick, which could give you a huge amount of risk reward as well. And I understand potentially these risk reward numbers seem outrageous and they seem potentially not even real. But I will tell you, I've traded this live every single day for years on end at this point, and there's many people that even match my performance. If that's something that you're kind of interested in joining that, there's a link in the description. I'm not going to really push it too heavily, but I have done this for years. I'm just trying to help you guys out and show you something that I know actually works. So that's how you can play this setup. Again, you have the liquidity sweep, 1, high time frame level test, 2, internal confirmation. You can have 3, the volume balance, 3, this fair value gap up here, 3. There's many ways that you could have gotten in with internal confirmation. The thing about internal confirmation is internal confirmation happens multiple times in one 4-pillar setup. All right, so this next example.
Juan Kerry News posted about Porto Santi.
I seen it.
Yeah.
I seen that. Let me finish doing this. I'm still researching on my side. I wonder if I could put photos, but I was looking at volume imbalance candle. So what is this? Volume imbalance candles. Volume imbalance. So what usually happens? If there's a volume imbalance, is there like videos about this. I'm still open to testing new stuff, but I have like a general idea of what typically ends up working, which I could apply on top of what I already learned. I think what I'm doing right now is really good, except it's just like, it's very rough. You know what I mean? I feel like I could earn a lot more, but it still works. Like, I've doubled my account, but we're trying to refine it, right? We're trying to refine it. We're trying to see.
Hello traders, welcome back to the channel.
I don't want to watch this. I don't want to watch that. I don't want to watch it. What the fuck? Okay, volume imbalance. But what happens? How do I think about a volume imbalance is a real thing. How should I think about it? What is a volume imbalance? The candle. I guess he has a video on this.
And today we're going to be talking about volume imbalances and overlaps, two fundamental technical analysis pieces to my trading strategy that you need to understand in order to follow the rest of the bootcamp series. Now, before we start, I've been working pretty hard to make the Discord free section a pretty good community, so go ahead and join up, ask questions in there. Any questions you have about any of these bootcamp videos, I'll make sure to answer in there. There's a whole free section, there's free channels, everything like that. It's not just live trading. So you could join in there, you could talk to people. There's a lot of people already in there.
Volume balance. I'm gonna watch this on my second stream, but well, I guess I'm gonna highlight this. There's a couple of volume imbalances right here. There was one right here. Oh, there's a lot because it's like damn near end of day. Volume imbalance right here. Big volume imbalance right here. But I mean, nothing really happened with them. What the hell happened with them? Nothing really.
And all your questions can be answered by me directly. So if you have questions about anything, don't hit the comments of this video, hit the Discord.
Is there a volume imbalance indicator so I could highlight more of this? I just want to see it highlighted. Oof. We were respecting this one. Why did we respect this one? I've seen multiple ones like this. Maybe this was a true one. Maybe this was in the middle of a trend. Let's find more examples, I guess. Oof, right here, I guess it would pay testimony or tribute to what he was talking about with volume imbalances. Volume imbalance right here. And then it was a volume imbalance along with, so it was like the perfect scenario. So essentially this whole area was spooky for price. So can you, like, if you set up, can you really predict some shit? If you set up something like that. We didn't have a volume imbalance right here. Where else could you use this as well? Let's see these two candles, okay? We have one, which is a pretty good candidate. Pretty good candidate, okay? And we have two. It's not a bad candidate either. It's not a bad. I would say this one's the best, though. So we have this one, which is that. Well, I mean, your protected stop would be right there. This one I'm also worried about. It's like, holy shit, we're fatiguing a lot. It really wants to go down. We have 3 potential candles that could be fatiguing right here. I should just leave them highlighted, huh? So you guys could see. We have one right there, and then another one right there, right? Because it was followed up with strong. Well, not really, actually. More happened right here, but it was still covered by protection. But as soon as we reach this level, it's like, why? You know what I mean? That's what I'm really trying to get. Volume imbalance. I guess I should just look at another ticker as well. Let's go to gold. See what happens in gold. Okay. I found a volume imbalance. Okay. But it wasn't protected. It was not protected at all. So we do have a volume imbalance right here. We do have a volume imbalance right there. And we have a volume overlap right here. Volume imbalance right here. But it never ended up reaching that. Yeah, I can never predict. I really don't know, honestly.
Ask questions there. I will be there. All the time answering your I want to show is an example I want to show to prove to you that this isn't just cherry picked. This is an example that's a little bit less clean, and it's an example where I make money on long on a day that only went down. And I'm going to show you this to show you that this setup is adaptable and it adapts to all market conditions. You're not going to have a time where the setup doesn't really work that well. It's always going to. So right before the market opens here, 1 minute before the market opens, what do? We look for the easiest equal lows on a high time frame. And in this case, our high time frame is the 15-minute chart. We're always looking for the 15-minute chart. So the easiest equal lows for me, these lows rejected off these lows. What does that mean? That means these are equal lows. Okay, these are the easiest. I understand that there is lows lower. Okay, I understand that there is lows lower, way down here, that look very enticing. And honestly, the market will probably get to those on this day because that's what the market does. But for the setup, we don't really care. We're looking for the easiest equal lows. The easiest equal lows is what we're looking for. And before the market opens, this high rejects off this high. This creates the easiest equal highs. Then we drop down to a 1 minute chart, just like before. We wait for one side to get ran. The lows get ran. Okay, so this creates our step 1. This is first pillar, liquidity sweep. Now we need a clean high time frame level test. I would argue not yet because price action is yet to cleanly test this. Right there. Boom. Our very clean high time frame level test right here. We have the liquidity sweep, then we have our high time frame level test right here. We lost the level for a minute, but we got back above it and we tested it cleanly. At this point, your internal confirmation should be covered for things. You could look towards this wick, which is a breakout wick, okay? Or you could take the high time frame level straight up. I believe what I did in this moment is I took the high time frame level straight up. I tried to play this to the other side. You could have also gotten involved somewhere inside of this breakout wick as it was happening. So if I dropped down to a 15-second chart, and maybe even a lower time frame, on a ticket back down into the top of this level, you see how price goes through it, and then it ticks back down into the top of the yellow, you could take it along there. Most internal confirmations are going to be a wick like this, but in this particular case, mouse trading, because the high time frame level test was so clean, I took this off of the next test into the high.
Trying to look for a breakout wick, what he was talking about.
Questions.
We all heard.
High time frame level, about half this range, we can stop loss underneath the wick. And the great part about the system is that we trade our stops. So my trade looked more so like this, and I got shut out somewhere up here. So I took about 5 hours out of this position. But what I wanted to show you is that look, price never even reached the other high time frame level. It actually failed the entire day. But because we have 1, 2 high time frame level and internal confirmation, 4 with the bias towards here, even if we don't reach that bias, we can still make money on this setup. So on a day that only went down, I made money on a 4 pillars long. And I made the amount of R that most people can't even make in like a week of trading. On one trade, on a day where it didn't even work that well. So that's the setup. That's the same setup that I've been running for years on end, and the same setup that's been making me a couple $100,000 a month every month for years on it. But I want to be very direct when I say this. There's a lot more that goes into this setup that I just simply can't teach on YouTube. I don't have enough time and I can't go through it on this video. That's for my one-on-one mentorship students in the 4 pillars mentorship. If that's something that interests you, the link is down. Actually very, very simple.
Pretty good video. I feel like I learned
That doesn't mean it doesn't.
some stuff. This area is the most interesting to me right now. Could this be like opposite, using like the opposite? We're pretty much just using this liquidity over here, but it happened over here. We're using this in the same move that happened over here. It's like, oh shit, this is what this was trying to do. But now that we've gone to this level, we could actually use this as support. So this liquidity that was right here, when we surpassed it, now we're using it for wow. I honestly don't know if this makes sense, to be honest. I really don't. I really don't. Oof, I got stomped out. Why did I get stomped out though? Let's try to see. If I held the original position, they wouldn't have broken my TP, my stop loss. It's like the whole universe is damn near telling me to literally just hold your stop loss. But that's why we're here. We're trying to analyze what the hell happened right here. I'm really trying to just highlight to see if there's any correlation. There's not. It's not consistent enough. There's no consistent enough correlation. Where is this? Right here. I just might be highlighting random ass shit right now.
All right.
Get more complex. It does. It's very easy to use and it's very easy to see once it's something that you know how to do. So it's called the 4-pillar setup because there's 4 distinct steps about this setup. The very first thing is that you want a liquidity sweep. Now, later in this video, we're going to go over exactly where to find that liquidity sweep. But right now, I'm just showing you the hypothetical kind of theoretical part of the system that you need to know. Once that happens, you need a high time frame level to hold. Again, how we mark these high time frame levels, that's something that I teach and that's something that I talk about in other videos on this channel and also in the private community. But marking the right high time frame level is important, and you need the high time frame level to come after the liquidity sweep. After that happens, you need a bias. So I use something that I call PDRs, or projected defined ranges for this. When I have a high time frame level hit, the PDR is set in motion to the next high time frame level. I'm saying level to level. That's basically what I'm saying. So once that happens, I have the PDR defined bias, projected defined range to the next level. That's pillar 3. Then you need some form of internal confirmation to tell you that everything is actually working how it should be. Typically, this is found in the leg that is right prior to the liquidity sweep, and that is usually going to be whatever held down price action breaking out and getting a retest of that. This provides entries with very tight stop losses with very large risk reward potential. The philosophy of this setup is that once you have the 4 pillars in motion, you have a stage. And until pillar 3 or the bias is completed, you are going to continue to have that setup. So you can take many entries on the same setup, and the idea is that the entries that you're taking, ultimately you're going to get lucky with, and because they have tight stop losses, you're going to be able to have a very high risk reward with a relatively high win rate. So that's pretty much the theoretical part of the system, just talking about it in a really basic drawing to get your brain kind of starting to understand it. Now we're going to go over a couple of different examples, real trades that I took in real time in the Discord in front of a lot of people to go over and kind of solidify this in your brain of what exactly you're going to be looking for. So the first example that we're going to look at here is Friday, July 17th. So the very first thing that I do before the market opens is I'm looking on a 15-minute chart for the easiest equal lows and the easiest equal highs for my liquidity sweeps. The easiest equal highs on top, in my opinion, is this collection of highs up here, sitting at the price level 841.25. So go ahead and mark that. And then prior price action, the current price action doesn't have a low against this low, so I'm going to consider these the easy equal lows. So go ahead and mark that. And liquidity sweeps can do before the bias in your brain of what exactly you're going to be looking for. So the first example that we're going to look at here is Friday, July 17th. So the very first thing that I do before the market opens is I'm looking on a 15-minute chart for the easiest equal lows and the easiest equal highs for my liquidity sweeps. The easiest equal highs on top, in my opinion, is this collection of highs up here, sitting at the price level 841.25. So go ahead and mark that. And And then prior price action, the current price action doesn't have a low against this low, so I wouldn't consider these the easiest equal lows. I have to look back in time, and these right here are the closest, easiest equal lows in price action. So now we can drop down to the 1 minute chart, and the great thing about this setup is nothing actually happens until we have a sweep of one side of these lows. So we sit on our hands and do nothing until one side is swept. That happens right here. This sets into motion our phase 1 of our 4 pillar setup. This is pillar 1. Now what do we need? We need a clean high time frame level test. So price action falls down beneath this big level quite a ways. And to be honest, this is where most people are going to get shaken up. They're going to see the market is trending lower. It didn't hold the level perfectly, and instead of sitting here waiting for the setup, they're actually going to get shaken up and probably try to go short off of a retest underneath this level. But we know trading this setup, and in the mentorship when I was trading this live on the day, all that I said is that, hey, we could go underneath this level, but since we ran the lows first, I know that we're looking for long. I have a bias that I'm going to stick to. The next thing we need is a high time frame level test, a clean one. When does that happen? That happens after price closes back above the level, and we get a clean test right here. So yeah, we were underneath the level, but we know that we're going long, so we need to test the high time frame level, and that's where we get the test right there. Does that test set into motion a PDR? It does, because holding this level sets into motion a PDR up into here, because again, we play level to level, so we think that we're going to go all the way up to 29,013.25. So we have all 3 pillars. All we need now is an internal confirmation. Basically, anything at all is something that we're going to be entering on at this point. Now, in terms of internal confirmation at this point, we already have 3 pillars that are set up. There's a couple ways that you can play this. And again, the 4 pillar setup is nice because there's always going to be more ways to play as long as the PDR bias has not been completed and as long as both sides of liquidity have not been ran. So the way that I ended up playing this is once that level got tested, I took the retest of that level right here with a stop loss underneath this low. The reason this is internal confirmation for me is because sometimes the high time frame level test can be internal confirmation. And understand, even if you trail out underneath this, you're making 13R in this trade. If you trail out all the way at the highs, and this is kind of unrealistic, most of the time you're not going to get this big of a trail out, you can make a potential 64R in this trade, which is fucking ridiculous. And you know, pardon me talking like that, but it is really ridiculous. Most of my winners are going to be in the realm of more than 10R, okay? The next thing that you could have done for internal confirmation is you could have looked at this tiny little wick inside of here. The reason why you could look at this little wick is because this is the wick on the leg down that held price action. And that retest of that wick right there at 578.75 could be something that you could take. This is also the reason why you could use this wick is because there's a volume imbalance right here, which overlaps the range of that wick, making this wick a more higher probability spot for price to long off of. And if you took this trade, stop loss.
Okay. Why that tiny wick though? I don't get it.
Would be right underneath the wick, which could give you a huge amount of risk reward as well. And I understand potentially these risk reward numbers seem outrageous and they seem potentially not even real, but
Okay. I sort of get it. What he was talking about, this tiny wick. No. Tiny wick right here, which would be the opposite. What the fuck? That's not what I meant. And then we pretty much just retested it. We retested it essentially. Okay, I think I actually deadass learned this. Because over here we had negative delta, which was pushing down, and when we were trying to push up to this, we essentially took a extremely okay. I sort of get this. I really do get this. Unless it's just it worked out for this instance, but that's why we essentially rejected as soon as we got here. As soon as we got here, from the opposite side of liquidity when we were pushing down, this is extremely good. Okay, so maybe past entries. Past entries. Puta. retested. Oh my gosh, this is kind of blowing my mind. Okay, that actually genuinely helped. This whole live stream session freaking helped. If I keep finding shit like this, then it'll be good. It could be used as support. Because if that's the case, this past entries, good support. Past entries, good, and it makes sense. What he's saying makes sense. Cause what I just did right now, he pretty much just did it, but except on a higher time frame. And essentially it retested it using some of that negative energy because, well, I mean, to beat this energy, you have to pretty much create a shit ton of liquidity and overcome it, which we did with this big ass candle that completely engulfed this candle and this candle, and then it went down, it took some of this liquidity and it pushed up. And so with my entry model, this would be a 1 to 7, and it would keep pushing up. But oh shoot, we're getting to the point where we got crushed. But it doesn't matter. We would have gotten a really good RR. A really good fucking RR. And if I just, it would be 1 to 11, 1 to 17. Holy shit. Wow. Wow. Wow, 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 wow. I kind of get it. I really do get it. What he just did, I did it, but on a macro level on a 1 minute time frame. But he was doing it on a 15-minute time frame. That's fucking beautiful, honestly. I think I'm satisfied. I don't want to find any more. But holy shit, this was a really good fucking education sesh. I hope everybody learned some shit. I highly doubt somebody watched this whole shit. Why the fuck would you? But honestly, I need some content, and this would be really good for me. So this was really educational for me. Holy shit, bro. If I could just improve my RR, bro. Essentially, you just waited, and then it retested these levels. And then boom, you just have a lower risk to reward like that. I will work on this tomorrow. That was pretty good. That blew my mind. Makes sense with the order flow and stuff. So we will see. Tomorrow